We say explain 4 determinants of money supply. Explain, that is 6b. Explain the 4 determinants. The 4 determinants of money. 4 determinants of money supply. 4 determinants of money supply. When you talk about money supply, that is money that is basically available to the economy. What are the factors that basically would determine? The number of factors that would basically determine the level of money supply. One of it, we can talk about the bank rate or the interest rate. We know for sure that when the interest rates are very high, we know that the supply of money is low. And when the interest rate is low, the supply of money is high. So we can put that on the board. We call the first one bank rate, stroke the interest rate, stroke the interest rate. We say when the interest rate is high, comma, the money supply is low. The money supply is low. While if the interest rate is low, the money, we say that the money supply is high. If the interest rate is low, the money supply is definitely high. We talk about the next factor, that is selective, what we call credit control. We can also have a factor called selective credit control. When you have credit control measures, for example, selective credit control, we know that credit is basically given to not all sectors of the economy, given to specific sectors in the economy. That will definitely lead to a lower supply of money. But if credit is not given selectively, we know that given to every area of the economy without selecting, therefore we know that the supply of money is going to be high. So we can put it what we call credit controls. Credit control. The second would be credit control. If there is a selective credit control, if there is a selective credit control in the economy, i.e. we say that the central bank and commercial banks issue orders. We say orders to the commercial banks. Issues orders to the commercial bank. Only to issue credits. To selective areas, areas. This will lead to lower money supply. This will lead to lower money supply, as opposed to the credit, being offered to all areas of the economy, to all areas of the economy. all areas of the economy. So if credit is given specifically to selective areas, we know that the supply of money is going to be low. But if credit is given to all sectors of the economy, then money supply would definitely be high. The next would be what we call the cash ratio. Cash ratio. What we call the cash ratio. And the question is, how does the cash ratio basically determine the amount of money supply? How does the cash ratio determine the money supply? How does the cash ratio determine money supply in the economy? For example, when the central bank, when the central bank, when the central bank increases the cash ratio, comma, this leads to lower money supply. This leads to lower money supply, especially during the times of inflation, leads to lower supply. And when the cash ratio, when the cash ratio is low, this leads to increase stock high money supply, in the economy. Stock high money supply basically in the economy. And that is what we call deflation. Another factor that will determine the level of money supply in an economy, we call it the open market operation, OMO. We call it open market operations. Open market operations. And when you talk about open market operations, this is buying, what we call buying and selling of the securities buying and selling of the security by the central bank. By the central banks. Buying and selling of security by the central bank. We take, for example, when there's a lot of supply of money in an economy, in order to reduce it, the central bank, we say that the central bank will sell security to the public. Will sell the security to the public to reduce, we say to reduce the money supply, to reduce the money supply in an economy, to reduce money supply in economy. So selling of the security basically to the public by the central bank, that will definitely be reducing supply of money. You say on the other hand, when the central bank buys security from the public, this leads to increase. This leads to increase in the money supply. This leads to the increase in the money supply in the economy. Leads to increase in the money supply in the economy. that definitely will lead to increase in money supply in the economy. We can also talk about maybe a few things, that you can do a more research on. Reserve, what we call reserve ratio, what we call reserve ratio stock, what we call the compulsory deposit. And we just explain it as an additional point. The examiner basically needed 4, and for each question, there was the point and the explanation to it. So as an additional one, that is reserve requirement. We know that all the commercial banks definitely hold reserves in the central bank. And you know, when they increase the reserves, when the central bank basically increase the reserve deposit or the compulsory deposit, what happens to the circulation of money or money supply is definitely going to reduce, as opposed to a scenario where they reduce what you call the reserve requirement or the compulsory deposit. When you look at that question critically, the question is 8 marks. So very important for the learners to understand that when you're tackling that question, there is the part of the point and the explanation of that very point. And that marks the end of that question.